Hello, in this video, we'll be going through the statement of cash flow operating activities using the indirect method, part 2. I'm just going to jump right back into where we left off of part 1. I'm just making 2 videos because they are very lengthy. So if you haven't watched part 1, please do so now. In part 1 of the video, we started building our cash flow from operating activities using the indirect method. We start with net income. We backed out all of our non-cash income statement items, and we started working through our adjustments in operating assets and operating liabilities. We got through all of our operating assets, and now we will continue with going through our operating liabilities. Okay, so this is a snapshot of the balance sheet that we've been working with, and specifically the current liabilities is what we're going to be looking at. And I'm going to start actually with salaries payable. And of course, you always have to look at the change between the beginning of the year and the end of the year. And our beginning of the year is $60. Our end of the year, our payable was $20. So our payable reduced by $40. And we have to know what our salaries expense, right? Because when you have salaries payable, the other side of the entry will be salaries expense. Our salaries expense is $300. We're gonna, using our T accounts again, I want to point out that hopefully you know this, but in case you don't, the T accounts, the debits on the left, credits on the right. So the payable is a liability, which is a normal balance is a credit. So I'm going to put everything on the right side. So my beginning balance is 60 and my ending balance is 20. So I have to build my story of what happened during the year. I know that our salaries expense was $300. So what we booked was debit salaries expense, 300, credit salaries payable, 300. So now I'm going to include this $300 credit for the expense in my salaries payable T account. Now, when I look at this, it doesn't balance. If I take 60 plus 300, that does not equal 20. So obviously we had a debit going on here that we need to plug, which is equal to the salaries paid in cash. So the way we get a credit to our, a debit to our salaries payable is we would have had to debit salaries payable for 340 and the credit must have gone to cash. Okay, so now we have a cash outflow of $340, but the actual salaries expense that's recorded in our income statement is only $300, which means we need to increase our cash outflow by $40, right? We need to increase this $300 expense to make it equal to 340. So if our net income, our starting net income is $120, right, which includes a salaries expense of 300, then we need to increase that 300 by $40 so that our salaries expense is actually $340 if we're reporting everything on the cash basis. So when I look at my decrease in my salaries payable, right, because it went from 60 to 20, so it decreased by $40, and that's what we're gonna decrease our statement of cash flows amount as well. And the way I'm going to label this is decrease in salaries payable and put minus $40. Okay, let's go to income taxes payable. I'm just kind of jumping around, but another current liability that we have on our balance sheet is income taxes payable. Beginning balance was 50, ending balance was 30. Right? Again, be careful as to where these columns are, that this is our beginning of the year and this is our ending of the year. So you're kind of looking in this direction. And so that means that our income tax payable decreased by $20. And we have an income tax expense for $40. So let's plug it away on our T counts. Our beginning was 50, our ending was 30. We had an expense for 40, so we would have debited income tax expense 40, credit income tax payable 40, and then we put into our T account, right, because here's my credit to the payable for 40. So 50 plus 40 does not equal 30, so I have to plug in my cash paid. So I know my cash paid was 60. It had to be. That's my plug. I would have debited income tax payable 60, credit 60. So my cash outflow is actually $60 total. What's on my income statement is only $40. So I have to decrease my cash basis by $20, right? Because I have 40, it should be 60. So I have to decrease my statement of cash flow net income by $20 out. So the way I'm gonna label it is I'm gonna say decrease in income tax payable minus $20. Now, let's look at deferred revenue. Deferred revenue is the same thing as unearned revenue. It's when we get cash in advance and then revenue is earned over time. We started with $50 and we end up with $80. Now, when we get our cash, we get the cash in advance, and then as we earn it over time, we would debit deferred revenue and credit revenue or sales. We had an increase in deferred revenue for $30. We have revenue, sales revenue of $1,800. If you think back to the first video, we already dealt with this $1,800 when we did accounts receivable. But because our balance sheet has accounts receivable and deferred revenue, it means that this $1,800 was actually split between these two accounts when we did our entries, right? When we did debit accounts receivable, credit sales, it goes into here. And when we did debit deferred revenue and credit sales, it also went into this number. So now let's look at our accounts receivable and our deferred revenue kind of side by side. We've already done the accounts receivable in part 1 of this video series. But we're going to assume that the $1,800 of sales is split as $1,000 recognized on sales and account, which means we had accounts receivable, and $800 was recognized from sales to customers who had previously paid in advance, which means we've earned our revenue that we got prepaid for. So here's how it would work. For the accounts receivable, we would have said debit accounts receivable, credit sales revenue for $1,000. Let's put that $1,000 right in here, that debit to accounts receivable for $1,000. Just hang on. I know that we put $1,800 here in the first video, and I'll show you why it doesn't really matter. And then we also had $800 of revenue for customers who pay in advance, and now we've earned that revenue. So we would have debited deferred revenue, 800, credit sales revenue for 800. So here's our debit to deferred revenue, 800. And here's how we recognize $1,800 of sales revenue that we see on our income statement, right? The $1,000 plus the $1,800. So if I'm looking at my accounts receivable T account, okay, if my beginning balance was 310 and my revenue was 1,000 and my ending balance is 380, that must mean that I received cash for $930. Okay. And then for deferred revenue, if my beginning balance was 50 and I earned 800, so I debited $800 for the deferred revenue account, and my ending balance was 80, that must means that I received an additional $800, right, for some more advancements from our customers. I would have debited cash, $830, credit deferred revenue, $830. Let's just see what is happening with each of these accounts, because I want to prove to you that we're still going to have a proper statement of cash flows. When we look at our accounts receivable, okay, let's just pretend this deferred revenue, we're just going to ignore this deferred revenue. Let's just say this is what happened and not the $1,800 of revenue all going to accounts receivable as we did in the first video. We had our beginning balance of 310. We're told that the sales on account was $1,000, and we have our 380, which means that it must mean that we received cash of $930. So meaning that of this $1,000 of revenue, only $930 was received. So we need to reduce our revenue by $70, right? Because our net income includes this $1,000 of income of revenue, but it should only include $930 based on the cash basis. So we need to reduce our accounts receivable by $70. And I want to show you what did we do to our increase in accounts receivable account when we reflected on the statement of cash flows. You can see right here when we had increase in accounts receivable, we reduced it by $70. So if the full 1,800 went to accounts receivable, we would have had a reduction of 70. If only a portion went to accounts receivable and a portion went to deferred revenue, we would still have a reduction of $70. Because when you're looking at the indirect method, you're looking at the change between the beginning of the year balance and end of the year balance, and that has not changed when we split up the revenue amongst different accounts. So now I'm back to here where, where I have the deferred revenue account, right? I analyze my deferred revenue account right here of what happened. So I have my beginning of 50, my I recognize more deferred revenue, or I'm sorry, I recognize my revenue of $800, and then I received more cash. So, and then to get to my ending of 80. So the cash received or the cash paid for all these T accounts is always a plug. Okay, it's just a difference. We're given 3 pieces of the puzzle to solve for the 4th. So let's see. If I look at just my deferred revenue, my income statement includes $800 of revenue, but I actually received cash of $830. So I need to increase my statement of cash flows by 30. Look at what happens. My beginning balance is 50, my ending balance is 80. That's my increase of 30. And that's what I'm going to record on my statement of cash flows. Right here, increase in deferred revenue. Next thing I want to see, if you just pause the video, do you see a pattern here for how we adjusted the non-cash income statement counts and the operating assets versus the operating liabilities? So just pause and see if you can figure it out. Okay. For the non-cash items, let's look at it. Anytime there's an expense, right, or a loss, which is reducing my net income, my adjustment was always the opposite. So every time I had an expense, I added back. And then anytime I had a gain, right, which is income on my income statement, I had the opposite effect. I deducted it. So if you have a non-cash expense or loss, you're going to add it back on your statement of cash flows. If you have a non-cash gain or income, you're going to subtract it on your statement of cash flows using the indirect method, okay? Now let's look at our operating assets versus our operating liabilities. I had an increase in accounts receivable, so increase in my current assets, I'm going to label that CA. The difference, right? This is the difference between my beginning balance and my ending balance. If I increase in my current asset, it was the opposite. I had to subtract it. Here, the same thing. Let's go the increase in my prepaid insurance, right? I had an increase in between my beginning of the year and end of the year. In my current assets, I deducted it. I subtracted it from my net income number. And then if I had a decrease in current assets, then I did the opposite. I did a plus. So this decrease was a change in my inventory balance. So I had a plus. So for all non-cash income statement item and all asset items, you're going to do the opposite of whatever direction they're going. And then for my liability section, my current liabilities, let's look at it. I had a decrease in salaries payable from beginning of the year to end of the year. So a decrease in current liabilities, same direction. I'm going to decrease my net income for statement of cash flow purposes. And if I had an increase in my liability, here's my increase in deferred revenue. So increase in current liability, I'm going to do the same direction, right? I'm going to increase my net income for purposes of statement cash flows. So opposite versus same. So these, for the adjustment for non-cash is opposite direction, and the adjustment for current liabilities is the same. So this sheet kind of explains what I just went through, but here it says your income statement items not affecting cash, right? Your non-cash, you do the opposite direction. So non-cash expenses, you're going to add back, like depreciation and amortization. Your non-cash gains, you're going to do the opposite. You're going to subtract it, right? And then it says your changes in current assets. Again, this does not include short-term investments, okay, which will be current assets, but you just have to remember short-term investment is not part of the operating section, operating activity. So if I have a change in my non-cash operating assets, usually these are current assets, you do the opposite direction. So if I have a decrease between my beginning of the year and end of the year, I add it back. If I have an increase in my current assets between beginning of the year and end of the year, I subtract it. And then the only item that goes in the same direction is a change in the operating liabilities, in the current liabilities, is the same direction. So I have an increase in my current operating liabilities, I'm going to increase my net income, and I have a decrease in my current operating liabilities, I'm going to decrease it on my net income to get to my net cash provided or used by operating activities. Okay, so this is kind of a neat little sheet to have, or you can just remember it. Non-cash items plus current assets is opposite, current liabilities is the same. So that's, you do what you need to do. So when I look at that, when I finish out my indirect method operating activity section, I'm going to look at the rest of my current liabilities. And if I looked at my balance sheet, I would see that I have an increase in accounts payable for $50. And here's that snapshot. I had $190 at the beginning of the year, $240 at the end of the year. So my liabilities increased by $50, my current liability, my accounts payable, and an increase in my current liabilities is going to have the same direction. So I'm going to increase my net income on my statement of cash flow. I want to briefly touch on this notes payable. This is a snapshot of the balance sheet, in which I included all the liabilities. This notes payable is a long-term liability. Okay, typically a notes payable will be long-term. And for the operating activities, we're just going to look at our current liabilities. So even though this is on here, I want to explain why it's not being analyzed for our operating activities section. So I just popped that in. This is the red right here. And everything else we've done in the video. So now you can see, now we're done with our operating activity using the indirect method. We start with our net income. Here's our non-cash income statement items and our non-cash operating assets and liabilities, which are usually just your current assets and current liabilities, except not short-term investments. Okay. And to get to my net cash flow from operating activities for $150. Let's talk about interest and dividends. I've said this previously, but any interest income and dividend income that we've received from investments are classified as operating cash inflows. And the reason for that is because the interest income and dividend revenue is determined in our net income. And if you remember, net income is our starting point for our operating activity using the indirect method. So that's why when you have to assess, was this cash or not cash, you have to have it as an operating activity difference. And so if we pay cash, right, for like if we have interest expense because we issued bonds, again, that interest expense is a part of our net income. So we need to determine, was that a cash outflow or not, to determine if we need an adjustment, it goes in our operating activity, because our operating activity is going to start with our net income, which includes the interest expense. Dividends paid, meaning we as a company paid out dividends to our own shareholders, are that's a component of retained earnings, because I'm going to debit retained earnings, credit cash, and that's going to be a financing cash flow. This dividend paid, remember, there's no such thing as dividend expense, so it's never in our net income to begin with. So this is classified as a financing cash outflow if we did pay cash dividends. And this is just a little sheet to kind of help you remember. Interest received is interest revenue, dividend revenue, interest expense. Those are all operating cash inflows and outflows because they affect net income. So those all go in the operating, just not dividends paid. Concept check. In determining cash flows from operating activities using the indirect method, adjustments to net income should not include what? In addition, for depreciation expense, well, depreciation expense, we do the opposite. So that is an opposite way. So that is going the opposite direction. A deduction for a decrease in inventory. When we have our current assets, we do the opposite direction. So if we have a decrease in inventory, that means we have to have an addition. So it's going to be B. Is going to be, that's the adjustment to net income should not include a deduction for decrease. That's going the wrong way. Okay, let's do this other concept check. The net income for Wabash Incorporated was $140 million for the year ended December 31, 2027. We have this information that we're given, and we have to calculate what the cash flow from operating activities during 2027 should be. Let's start with our net income. It was $140 million. We're going to build our statement of cash flows. First item that we're given is amortization of patent for $1 million. Well, that's an amortization expense, right? And that's going to be a non-cash expense. We're going to do the opposite direction, so we're going to add it back. Next item, cash dividend paid for $14 million. This means dividend paid on our own stock. That's going to be debit retained earnings, credit cash. That means it's a financing activity, and we are not going to report it on our operating activities, so it's not going to be included in our computation. Okay, we had a decrease in accounts receivable for $9 million. Accounts receivable is a current asset. We had a decrease in our current asset, means we do the opposite. So we're going to add the $9 million right there. So we call it decrease in accounts receivable, and it's a +9. Next, decrease in salaries payable. Salaries payable is a current liability, which means we go the same direction. So if there is a decrease in salaries payable, we're going to decrease our net income for statement of cash flows by $1 million. And there it is, decrease in salaries payable. Next item, depreciation expense. This is a non-cash item, non-cash expense, right? Because we debit depreciation expense, credit accumulated depreciation. And we're told we go the opposite direction for depreciation expense. So expense is reducing the income. So we're going to do the opposite way, and we're going to increase our net income for cash purposes. So depreciation expense +20. And next is increase in, that should only be one line at a time, but that doesn't matter. Increase in long-term notes payable, $13 million. So take a pause, because you're like, oh, liability, I do the same, right? I should have a +13. Except increase in long-term notes payable, long-term liabilities is what? That's going to be a financing activity, okay? So that's not going to go into my operating activity. And then same thing with sale of preferred stock. When we sell stock, it's going into our equity section, right? Because we debited cash and credited preferred stock for the 17 million. And that is going into our equity section. So that's a financing activity. So we don't do anything with these last two transactions in the operating activity section. So our total cash flow from operating activities, when we take the $140 net income and then adjusted for these items, we get $169. So our answer is B.